Now, what I'm getting ready to say to you guys and explain probably has happened to most traders, even beginner traders to even novice traders that are more professional today or experienced. So, let me give you or let you know about two things that the banks or institutions don't want you to know. Okay, it will probably help you in your own trading. So, these things are kind of manipulation or games that the institutions or banks like to play, especially, the market makers like to play the puppeteers. All right. So they will manipulate the market to move in a certain direction to scare traders out of their trade. And then the trade ends up moving in a direction, right? So maybe you've seen or have noticed where or waiting on a market to pull back to a key area of supply or demand, a zone that you've been interested in trading from. The market gets to that zone, right? And once it gets to that zone, you're looking for a rejection, of course. Depending on your strategy and how you trade supply and demand. And if anyone is interested in understanding the strategy and how I trade supply and demand, there are tons of videos here on the channel that you can watch. Some of them are live trading recorded sessions, and some of them are where I'm going into detail about the strategy over and over and over again. And why do I do that? Because I want people to understand how to trade it correctly. But it's up to you. If you have a strategy, how you trade supply and demand, and you're consistently profitable, then that is a plus, and continue doing so. I always tell people, if you're making money, whatever it is in the markets, continue doing it. Do not break that consistency. Don't break, just the routine of things that you're actually doing, okay, surrounding the strategy. So you see the market come back to a zone, supply or demand, all right? And then you get into a trade when you get the rejection and confirmation, right? For me, I'm looking for a few things to happen, especially when I move down to a lower time frame chart or a lower base chart, not time frame, because I don't trade time based charts. And then I'm noticing or looking for at a zone that's created, okay, a break and closure of a candle, and then I take a trade. But once you're into a trade, the market comes back against you, all right? And maybe you have your stop loss placed to where you're going to get out the trade at, and it comes up there and hits your stop tick to tick, okay? Or it runs that stop by wicking out that area just by a few ticks, and then the market moves in your direction. This is the manipulation that the market makers like to play, okay? You can identify the institutional levels zones on the bank, on your charts, not the bank. What am I saying, guys? Sorry about that. The institutional or bank zones on your chart. We're talking about supply and demand, because when you see aggressive selling and buying in certain key areas where the market has moved quickly away from an area, you've got to understand that that's where the institutions are placing their orders at, all right? And sometimes they'll set up multiple zones, okay, where they're making power plays. And say, for example, the market is bullish and breaking structure to the upside, and then it pulls back to a zone. But within that area, after you identified a structural break, then there could be two zones, meaning two demand zones if the market's moving higher and breaking structure, that are left behind to where the market could actually tap into either one of those, okay? And either one of those zones could be valid, and I'll show you an example here. But what I want to explain to you first and foremost is that, look, if you're struggling with actually profiting and becoming successful in the markets, please do yourself the biggest favor. Stop now and educate yourself on market structure. I've done a few videos here on the channel. I did a great video or breakdown about market structure, which I posted over on for everyone that's an elite member. And if you're not an elite member, maybe something you may want to look into. It's only $6.99 a month, but I did a great market structure video and made it placed it private or put it private to that community of individuals. And why? Because I have to be able to give something back to those individuals that support me as a content creator. So that's a perk or reward that those individuals do receive, okay? And I appreciate everyone who supports my efforts as a content creator. And if you'd like to do so and receive the trade breakdowns where I go in detail about my trades, that market structure videos, and in time I'll be posting other content, but you also receive my video playlist. Then if you scroll down to the description portion of this video, you'll see a link there that is titled, right below the Discord link, it's titled Become an Elite Member. Click on that. 2 tiers will pop up. Make sure to choose the one for $6.99 a month. That's all it is, okay? And you get access to the private videos. Those videos have helped people out, have helped plenty of traders that are that follow this channel. I should say that, okay? But getting back on topic here, and if you're interested in joining the Discord, that's free. The link is right above that link in the description. But look, structure is everything. So if the market is moving higher and we're breaking structure, say for example, like right here, where we started to move higher here and we started to break structure back to the upside, as you can see. Of course, we would be looking for pullbacks to key areas of demand, like here or here, all right? But one of the key things I like to see, all right, when I'm trading either a supply or demand zone is, did we have a break of structure, where there was a supply or demand zone that was left behind, pretty much. When a structural point was taken out, was there a demand area left behind? Was there a supply area that was created, for example? Okay. So, but what I'm trying to show you is here. Let's say, for example, the market was moving lower right here, and you've probably seen this a lot of times, or it can be moved to the upside, where it's breaking structure lower. Now, this is a supply zone right here. Let's say the market pulled back to the supply area right here, and then it pushes away from that area right there, and you got into the trade to go short, right? But then shortly after, now this is the 120 range chart. I'm not like going in detail about the strategy, but I'm showing you examples of what the market makers, what they like to do to spook people out of their trades. So basically, they're looking to stop you out in a sense, or collect your money, or running some means of areas of liquidity where they know people had actually entered trades and possibly put their stop losses at. Their game, their end all is to collect liquidity. But it's our goal as retail traders to identify their moves and then trade with them. We don't want to trade against them, okay? Because they have the big bucks, the money to be able to railroad you at any given point. So let's blow this up a little bit. What we see is the market pulls back to an area of supply right here, right? Okay? So maybe the market, this is just hypothetically speaking, and don't pay attention to it being a 120 range chart, which is a higher base chart. I'm just showing you what we will look for as far as rejection. We'll look for that break and close of the candle and a lower base chart for all those that know about the strategy and how I trade. But anyways, the market breaks and then it starts to pull back here. Now, if you're in this trade going short, you're kind of getting a little iffy, right? You're like, okay, I probably need to close out and get out of this trade because it looks like it's going to push higher. Well, lots of times what they'll do is they'll pull back, okay, force you out of your trade. At that point, if you enter somewhere down here, you lost money, right? And maybe you most likely you got your stop resting right here around 20,495 or a few points above or ticks above, because I talk about that. If you put your stop tick to tick at the back end of the area where you enter a trade at, then what's going to happen is the possibility they can actually come up and test that area and then stop you out, and then the market just runs in your direction. I'm sure that's happened to a lot of individuals. So these are the two things this is number one that I wanted to talk about is for you to understand wherever you put your stop at, you must understand in some instances that they know that where you place your stop at more than likely, okay? Because they set up these plays within the market, and they set up areas of liquidity all over the market, okay? Because they want to be able to entice traders, retail traders, to put on positions or and then fake you out and then stop you out, okay, by collecting that area, running that area of liquidity where your stop is resting at, and then they move the market in your direction. So you've got to think smart like them. If this is a supply area and we're already breaking structure to the downside, then more than likely they're probably going to do what? They're probably going to continue pushing lower. So if you got into this trade, again, know for the fact that they can come up here and position or pull the market back to stop you out here, and then the market moves in your direction, okay? Either whether it's they pull back some, okay, and don't quite hit your stop, or they actually come all the way back tick to tick where your stop is at and maybe run it a few ticks, and then they moving in a direction. Now, what a lot of people will do is if it does, let's say, for example, it did come back above, I'm talking about this area. Let's move this box. This is the supply zone. Let's move this box right here. If I grab an arrow here, just to show you, and they run right above this area here, because that's probably where you're going to put your stop at, maybe by a few ticks above that or a few points, okay, right up, maybe somewhere here, and then they run your stop. Now, that supply zone is still valid, okay? It's still actually valid because they haven't broke through the zone yet, okay? Meaning they haven't cleared the actual zone. So, can you re-enter the market? Yes. I mean, if you get another rejection, you can say, okay, this is actually, they're just trying to spook traders out, grab liquidity, and then they move in your direction. You've probably seen that, again, like I said, many times before. So either they pull back, try to stop you out by scaring you out of the market, and then you lose money, or they come back and hit your stop full on, or if you're smart, like I say, you don't put your stop tick to tick, give it a few points room. But let's say even they stop you out there and then they wick that area again. Wicks at a zone or Very critical, okay? Because if you see with the market, say for example, this is a good example right here, where the market comes back, it taps the zone. Let's see, I think it, yeah, taps the zone there, okay? Taps the zone, say for example here, and then wicks it out. Now in this case here, we got a full body close of a candle, but not into the zone. But let's say it wicks that zone and then quickly moves away from the zone. That's a good indication that they still want to move short. And eventually they come up here, they hit the zone, and then they move lower, and the market comes down here. And what do? They take out liquidity on the bottom end. That's the last low that they made before pulling the market back right there. Now the second thing that I want to actually talk about in reference to trading supply and demand and letting you know what the market makers, how they manipulate the market in a sense. Is, let's say from this point here, we start, making bullish movement to the upside here. And you've probably seen this a lot of times, okay? So the market is breaking structure higher. It pulls back and then it breaks structure right here. We take out these highs right here, the last high that was made at 20,742. Now, we have on the break of that area of structure here, again, we have multiple demand zones. We have one here, and then we would also have one in this zone down here. Okay, so we have two. You're thinking to yourself, which one makes sense to actually trade, And the reason why you have to think logically which one would make sense would be this one down here. Why? Because that's where their move started from, where the banks, the institutions were really pushing or driving, filling orders to push the market higher. So it created, you see the aggressive force, the aggressive pushes to the upside. Wherever you see lots of buying, in this case here, or it could be selling in reverse of, the market, that's where the banks, the institutions are placing these big orders like that, especially when you see like these loads of candles to the upside. You got to think logically speaking that the institutions are doing this. So what typically happens is that they will, set up shop to where they'll create multiple zones leading up to the break of structure. Okay, this is a high here. This is a major high to where the market broke higher, and as it pushed higher, it created this zone here and this zone here. Again, which one makes sense? Well, it really, this one is the best. This one is okay, but it's only because we're, if we run a fib, I don't trade fibs. I just want to show you, for example, here where the market broke structure right here. So I run it from the low where it started with that push to the upside. This puts us right below the 50% area, below that area there. In reference to the fib, okay? So back at the 61.8 or 76.4, that's where you want to typically be looking into, enter a trade somewhere at the latter portion there. And as you can see here, the market reacted at both zones, at the break in that area structure right here. It reacted here, broke above, it tapped into this area of supply right here, so aggressive selling right here. So be mindful that there is a supply zone resting above, okay? But this is a supply zone where there's no break of structure, but it's still a supply area, okay? Where the market ran back up to. And then it pushed lower, and it did break this area structure right here within this swing right here. So this would be a minor structure break to the downside, or what lots of people probably would classify as like a minor bearish structure break to the downside within this zone here. Okay, so we haven't broken any significant area yet, meaning this low right here, but still the market is, making lower highs as it's pushing lower. Now this right here, if you pay close attention, right here, this was a structure break to the downside after it broke right below this area here at 20,602. As you can see, it pulled back. This is a supply zone right here, and it rejected. We did get a small break of structure right here to the downside. This is what I would classify as another bearish break of structure to the downside, okay? But on the move to the downside, it does tap that area of demand, but be mindful what's resting right above here as well. What is this right here? Take a look. This is a bearish break of structure right here to the downside, okay? So this is a supply area right here, so be careful right there. If you went long right here, be careful that there is supply right here, and that's why the market would bounce right here. So anyways, in reference to structural breaks, pay close attention because they will set up multiple zones sometimes. There could be one here, here, and here. So if there's three, you got to kind of think logically speaking, okay, we just broke structure to the upside, but I have gaps that need to be filled back down below, and there's three demand zones. Which one should I take? Just be smart about it and understand that taking a trade below that 50% area, okay, back at the 61 or 76, percent area is going to be your better option. All right, and that just comes with you understanding probability of setups within the market. Okay, yeah, this was aggressive area buying right here, more so than right here, for example. Right, so what I like to do is I will pull what's called like a micro range volume profile, and I like the volume profile. It's actually one tool I like to use. I know people are going to ask me, or someone's going to ask me, hey, Mike, which one do you use? I use the one from discotrading.com, but they currently you're not able to purchase it from them any longer because of sanctions overseas, everything going on with the war and stuff like that. So, it's no longer available at this moment, okay, for new purchases. Anyways, so what I'm trying to say is that if I run a mini or micro profile from here to here where the structural break took place at, well, I'm looking for an area where most of the volume kind of centered around, okay? And it's in this area right here, okay? Right here. And if you look at this little small area where I drew this profile at, you can see that little pinkish line. That's the VPOC area of this micro profile right here. So when the market got back here, as you can see, I always talk about in prior videos, buying below the volume area, okay? The high volume area, and then taking a trade going long. If you see that when the market, so it just gave me multiple means of confluence right here. We're below, say for example, we're back at the 61.8% fib, okay? I'm not trading fibs, I'm just saying taking trades where there are multiple areas of demand, or it could be supply. It makes sense to kind of understand, do I want to take it at the latter area of where there was a structural break, where there's a demand zone at, one here, or at the upper portion? If there was a third one right here, demand zone, we're above the 50, we're above that, probably back at like the 31.8 or the 23.6 or whatever it is, in that area there, I'm not interested in that, I'll be honest with you, okay? Even though the market can't reject there, I'm interested once we start pulling back below that, back around that 61.8 or say the 76.4 back in this area here. Using the volume profile tool here, we also have this high volume area, and I'm interested in taking trades below that area, as well. So just down here, when the market got back down here, it comes back. Now that's not a major volume area right here, but still we're back absolutely almost back at where the move started at. So it makes sense to take interest in trading that area. So you have to, again, think logically speaking when it comes to terms of where to take actual trades from, and where to get into the market at. You have to think in reference to, are there multiple zones? Which one makes sense? And then in reference to stop loss placement, you have to know that the banks, the institutions, the market makers, they are going to, manipulate the market in any kind of way possible to stop traders out. That's their end goal. That's what they want to do. They set up traps, and those traps are liquidity where they're going to take you out. And, they allow retail traders to basically use them as pawns to set the traps up for them. Okay. So, and they know where your trade setup, not trade setups, where your stops are going to rest at. So they're going to try to run those areas and then move in your direction. So just be careful. All right. These are the things I wanted to talk about today, and things that two things that I really want to show you, when it comes to trading supply and demand, to be on the lookout for. Okay, because the people always, or get frustrated when their stop gets hit, and then they question, why did it get hit? It was we had to break a structure, it pulled back to that zone. Well, you have to understand as well, not every area the market's going to hold at. The market's going to do what it wants to. We as retail traders do not have or put a dent in the market. They are going to try to railroad us in any way possible. It's all about probability, understanding what areas make more logical sense to trade from, and also understanding, the fact is using or putting into place, have multiple means of confirmation to be able to take a trade. And that's why I like using multiple charts or chart confluence, is marking a zone from a higher base chart right here and then moving down to a lower base. And okay, if we are bullish here, then I'm looking to look for bullish activity to take place on my lower base chart and wait for a rejection for confirmation to get to a trade. I talk about the strategy across the channel, guys. So if you're interested, please take some time to watch the videos as well. But that's all I want to share with you guys today. I don't want to kind of overdo things, and I can continue talking about this type of stuff. But I've talked about it before. And if you're interested in joining the Discord, guys, all you got to do is look down or scroll down to the description portion of the video. Click on the Discord link, or if you want to become an elite member, click on that link, and that's pretty much going to wrap it up. If you're not a subscriber and you're a first-time viewer, please take the time to go ahead and click on that sub button today. Become part of the community. There's lots of free information and valuable content right here on this channel if you spend time watching the videos. But that's all I have for you guys today. I appreciate everyone tuning in and watching them. If you do me the biggest favor of all, and that would be to drop a like on the channel, or not the channel, on the video. I appreciate that. But yeah, make sure to turn your post notifications on too, so you don't miss one of the uploads. Take care and see you in the next one. If you're trading right now, please be safe in the market.